Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager, Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. We're in the midst of moving our monthly update videos to a 2.0 version that's shorter and more interactive, integrating questions and observations we get from allocators and advisors. Of course, we'll keep positioning and performance as key parts of the 2.0, but stay tuned over the next month or so as we move to this refresh. Meantime, this update looks like it's going to be our shortest one to date, but I think you'll still find it really interesting. So without further delay, as we do each month, Andrew, on to your commentary.
Thank you, Mike. And thanks to everyone for listening in. So we've had a very strong start to the year, up about 6%, in line with both the SocGen CTA index, here and after the hedge fund index, and the Morningstar US Trend Systematic category, here and after the Morningstar category. And since inception, we've handily outperformed both. But more importantly to the model portfolio world, the S&P 500 has returned around 7% this year, but the Bloomberg Ag is down close to 2%. The big news on the macro and positioning front is that hedge funds overall are finally buying this equity rally. The Fed will pivot, they say. It's just a question of when. AI seems unstoppable. We sidestepped the scariest landmines of the past 2 years, and the prospect of a Trump second term, while deeply disconcerting to half this country, could make capitalism cool again. Higher rates are now more about strong growth, not inflation. And so, as noted, stocks are soaring while bonds are struggling. A big shift from 2022 and 2023 when everything seemed to move together. On the positioning front, we're also risk on. We've dialed up equity exposure, are back in the king dollar trade. Commodity longs are creeping up, and we have a yield curve flattener. The gold and flattener to me look like hedges against that equity exposure. With that, next slide, please. Here's our chart on stocks, bonds, and DBMF. Note the move so far this year. Like in 2021, we're going up with equities. That's a big shift from 2022 and 2023 when we were largely in crash protection mode. So it's important to understand that managed futures funds will be long and short at different times, but that the correlation should be around zero over a market cycle. For those who like statistical calculations, the correlation to the S&P 500 has been a negative 0.26 since inception nearly 5 years ago, with annualized alpha over 900 basis points. If you build model portfolios, stats like that are very hard to come by in a hedge fund, and even harder to find in a mutual fund. Hence, the whole point of DBMF is to seek to deliver this diversification bang for the buck and show that we can do it in a client-friendly ETF. Now, we're still only 0.01% of the ETF world, but we are working very hard to change that. Next slide, please. Replication, as we say, is not perfect, but it's the best way we've found to deliver, quote, index plus, end quote, performance relative to hedge funds. So one criticism that we've heard that really makes no sense is that 10 factors are unable to capture the nuances of a more complicated portfolio. That false assumption is grounded in this idea that you have dozens and dozens of truly independent, or to use fancy statistical jargon, orthogonal risks out there. But that's nuts. I mean, take junk bonds. They're obviously a combination of rates and equities. So here's a chart titled, How Simple Can Replicate Complex? My partner Matthias built this research graphic, which you can play with to your heart's content on our website, www.dbi.co. What it shows is that most instruments we do not trade can be viewed as combinations of the 10 big factors we do trade. So clearly, some really do march to the beat of their own drum. Take a look at those 7 factors tucked away in the left and right margins, but the vast majority are not. For anyone who read our article in Institutional Investor last fall about 4-factor replications, this is another brick in the quote-unquote replication works wall. Next slide, please. So as you all know, I think the asset allocation world changed a lot over the past several years, but given how slowly this world moves, those changes will play out over the next several years. So in the what I consider to be jaw-dropper category, take a look at these 2 charts. Many allocators build capital market assumptions off 20-year trailing returns. The graphic on the left is the S&P 500 versus Bloomberg Ag from 2000 to 2020. Now imagine you're building a model in early 2021. Bonds had beaten equities for almost 18 years. Now look at the stats on the bottom. bonds returned 3% more than cash, with a Sharpe ratio of 0.9 and a max drawdown of 3.8%, with slightly negative correlation. Absolutely unbeatable as a diversifier. Take 40% of a stock portfolio and put it in bonds, i.e. 60-40, and your max drawdown drops 40%. Your vol by a similar amount, and your Sharpe ratio jumps 50%. Bubbles make people look like geniuses. Now hit the right chart. All we've done is shift this forward by 4 years. The returns over cash have dropped in half, the Sharpe ratio is down nearly 60%, and the max drawdown is 4 to 5 times deeper, and correlations have flipped to positive. So the point is that it seems very unlikely we will ever return to the halcyon days of 60-40 because no allocator can erase the bondtastrophe that has played out in the 2020s. And no, I do not think allocators will abandon bonds, but rather I think it will be obvious in a few years that allocators need better arrows in their quiver. And we'll see that managed futures should have a permanent strategic role in diversified portfolios. And of course, we think our investors may look very prescient for seeing this years before their peers. Next slide, please. Finally, here's our standard chart on volatility adjusted positioning. Columns are current volatility adjusted positioning, and the dots are from the end of December. And this is what I mean by a pivot into some big trades. Look at the increase in the EFO long, the dialing back of the EM short, and how the portfolio is now short both the yen and euro. From a risk perspective, that's where the real action is. We've seen periods like this before. When the world goes strongly risk on, managed futures will follow. But now, please, it's important to remember that the strategy is very dynamic. The positioning has worked very well for us year to date. But if we see a reversal and get back some gains, the underlying hedge funds, and hence the replication, will pivot out accordingly. This tactical dynamism and potential alpha generation is why managed futures, and hence DBMF, can work as a complement to slow-moving model portfolios. With that, I'll hand the baton back to Mike.
Thanks, Andrew. So let's wrap here with our long-term performance comp. Rising tides for managed futures have lifted all boats so far this year for DBMF and for its benchmarks, but DBMF continues to outperform since inception, ahead of the SocGen CTA index by 145 basis points annualized, and ahead of the Morningstar Systematic Trend Index average by over 330 basis points annualized. Upon request, we can also provide performance numbers prior to the inception of the ETF, utilizing historical performance from the SMA version of the strategy. Our case for DBMF is twofold. First, in efficiently and effectively representing the managed futures asset class, providing true and potent alpha-generating diversification to traditional stock bond portfolios, and as such, we believe it should be a strategic long-term allocation. And competitively, we believe in DBMF we have a superior mousetrap in the managed futures space. The strategy seeks to deliver highly correlated outperformance versus the index, which we have done historically, while keeping fees low and single manager risk mitigated via our disciplined replication approach, all in a liquid, easy to implement ETF. So thanks to all of our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com. Thanks. Till next time, take care.